So Credit Karma, has anyone use Credit Karma? That's a very good model because that was saying, we'll give you free credit information, free credit score, and that became a pretty interesting signal about your intent to improve your credit score. So in credit, the old rule, behavior trumps financial data. Two people with identical financial, same income level, same debt level, one pays you back, one doesn't. It's due to behavior. How do you measure behavior? Credit scores do a great job of predicting the past. So if you think the past is going to be equal to the future, i.e. you have a job, you will get a job, they rank order credit very well. If you're going to be different in the future, something's going to happen good or bad, they don't predict that. So that's what maybe you could use data to do. So there's lots of models around that. There's lots of asset classes. We're going to come back to that. So term loans, payday substitutes, retailer-driven credit at the point of sale, student loans, mortgages, all kinds of business lending ideas, lots of tools and services. We have a fascinating company that uses machine learning to do collections. Say that we can actually do better than humans do on that. And now with AI, it's like say now with niacin or something. It's like every company now uses AI, and then we've invested in these companies here. Okay, so we have these we have frameworks for investing. So it drives me crazy when people I'm a big believer saying, okay, what is your criteria? If you have 100 or 200 different data, credit companies that you're talking to, and we get usually about 20 inbound companies per week, just to get a sense of the volume of things. There are several thousand fintech companies that have received venture money. So how do you decide? And you can say, well, management. Well, of course, management makes a big difference. But what other criteria? So we developed these criteria. So we have these rules. So first of all, any lending business has to have fair and transparent rules that don't trick the customer into a profitable relationship. So in other words, like hidden fees, it's free, 0% interest rate, but if you skip a payment, we then back charge you for all these things. A lot of payday lending schemes, I feel, basically are incented to keep you borrowing. And it's not profitable unless you keep borrowing. It's not profitable to the originator. There's many, many things that don't rely. It's not transparent. If all the facts were known, the borrower wouldn't do it. So we insist that we don't do any of those businesses. The best businesses incorporate credit in a seamless way into the daily activities of the company. So a good example of this, we have a portfolio company called Fundbox, integrates into the general ledger, and they create a graph of all the companies you've ever paid or been paid by. They also score you to how accurate you are and how fastidious you are about maintaining your ledger. Do you do all your entries at end of the year, end of the month? Or
you don't want to look at mine.
Exactly. And they score you, and they score all your counterparties, every receivable, every payable, and every receivable. And then if you have a receivable, you click on it, and it will say, we'll offer you 94 cents on that receivable, and the money's in your account that afternoon. That's a great integration. It's creating a competitive advantage of information that no one else has. It's a compounding competitive advantage, in our opinion, and it's a seamless integration of credit. It's not, no one's going on the internet saying, I need credit. You don't invest in businesses that do that. And, the issuer has to have an enduring competitive advantage of information and must demonstrate that over a cycle, because lots of companies say, hey, we have all these engineers, we built this model, and you say, yeah, but you back tested it for a few months, or enduring competitive advantage in loan origination, and then eliminate funding risk. So this is a key thing. So every 5 years in the United States or so, you have actually I'll do this question. So what does 1962, 1970, 1974, 75, 1979, 1981, 1984, 1987, 1990, 94, 98, 2001, 2008 have in common? Say that?
Economic downturn?
Not always. It's basically there's a liquidity crisis. So for periods of more than 6 months, there was no access to the capital markets in each of those times. So if you're in the capital markets, you say like, okay, suppose if you're a bank, you have to do liquidity testing, and say suppose we had no access to markets for 18 months. This is something we learned in a rather dramatic way at Lending Club. You have a problem, funding stops. So what do? You can't say, well, we run out of, we fold up, go home. So this is a key issue. On marketplace structures, it's the company has to accurately predict cash flows. You're selling those cash flows to investors. Asset class needs to be big enough that institutional investors care and will do the homework. And so in my view, it has to be, $10 billion or bigger with fairly standardized assets. And then the risk-adjusted returns are attracted to real money investors. I'll talk about Lou Glucksman. I'll show you his picture in a second. But he used to say, speculators are always on one side of the trade or the other. You need real money investors. But liquidity comes from having real people who need capital on a regular basis and people who are prepared to invest capital on a regular basis. So, what have we learned the last 5 years? I still think there's a big asset class, but not everyone's a good underwriter. It's proving that a lot of these companies are not good at predicting cash flows at all. And some of these data sets, you say, oh, we use Yelp data to underwrite small business loans. Basically, it's proven to be meaningless in underwriting small business loans. Regulators are very focused on developments. I think that they are interested in it. They're not necessarily antagonistic. We got a big change in administration. No one knows what that exactly means. And what I'd say is a lot of this is not totally settled yet. And scale matters. There's very high customer acquisition costs in many of these models. Some of them don't have adequate capital generation rates, so they can't fund the balance sheet given the growth that they have, and lots of operational risk. And liquidity in this space is highly correlated. And that's my old boss, Lou Glucksman, who used to say, the whole key, the secret to Wall Street is learning the same lessons have to be learned over and over and over again, and no one's around to remember what happened last time except for me. So I am now Lou Glucksman, talking about 1966. And
so you use these criteria as a startup's coming in to pitch you. You're using this criteria in the background to evaluate.
Yes, and I'd say the 5 core rules. Those 5 core, go back. These lending business 5 rules, I'd say many companies fail all 5 tests.
All 5.
It's rare that someone meets all 5 tests. Very rare.